Hello, welcome to this tutorial. I'm your accounting coach, Michael Sakala. Today we are going to look at loan amortization. I'm going to demonstrate to you how a loan gets to be repaid. This is a very important topic in corporate finance and financial management, as the case will be. All right. So now let me demonstrate by basically putting up an example. Okay. So I will illustrate through the example as I'll be explaining, as I'll be solving. I'll be explaining certain elements of loan amortization. All right. So let's look at an example. Michael wishes to borrow $1,000 from the bank at an interest rate of 10%, which is to be repaid over a period of 3 years. Okay, so Michael wishes to get a loan from the bank of $1,000 at the prevailing interest rate of 10%, and this loan will be repaid over a period of 3 years. And then required there, we've been asked to calculate the annual level payment. That's the first requirement. And the second requirement, we've been asked to construct an amortization schedule. All right. So now when we talk about the annual level payment, this is the payment that basically Michael will be paying every year. In our country, if you get a loan, you pay monthly basis, and that amount does not basically change. Okay, so the annual level payment, think about it like that monthly payment that you always make, and it shouldn't change. When the bank deducts, they should deduct the same amount, believing that the interest rate is the same. So the bank will deduct the same amount over the tenure of the loan. Okay, so that's the amount that we're going to calculate, the annual level payment. So I'll say solution here, solution, and I'm discussing solution 1. All right. So the annual level payment, this topic is actually bordered on the concept of time value of money. I'm sure you've watched that video on time value of money, where I introduced the concept of time value of money and I explained. So now today we are going to apply the concept of time value of money to amortize a loan. So what we are basically calculating is PVA, present value annuity, and then the A is the annuity itself, meaning the annual payment. This annual payment does not change. It will be constant all the time because we expect the bank to deduct a constant amount every time we are repaid. Okay. So now, when does Michael wish to borrow? How does it happen? Do we start making payments towards the loan and then borrow later, or we borrow now and then we start making payments? Of course, we are borrowing now. So the amount that we are borrowing is what we are calling as the present value annuity. Okay, because we are borrowing now and then we start making payments after borrowing. There is also a future value annuity. That's not my interest, where we start making savings now for preparation for retirement, meaning the bigger amount is expected to be received in the future, but here the big amount is expected to be received now. So we are dealing with present value annuity. That's where the 1,000 is going to sit here, PVA, and then the A, this is the annuity, that amount which we are talking about that will not change over a period of time, it will remain constant. And then this is the formula for annuity, present value annuity. We are just applying it. You should know it. It can also be obtained from the tables. If you've got present value annuity tables, you will see these numbers, they will be given in the table. You don't need to stress to put up the formula, but I like it the formula way because it keeps your mind exercising. Alright, so 10% is 0.1, which is the rate there. How many years is this loan? The loan is for 3 years, -3 there, which is n, over 0.1 here, and then we have that. Okay, now what we are looking for is the annual level payment, which is the A here. So I'll begin by calculating this, and then I'll sort out what the A is. Okay, for those of you who might need help with the calculator, you begin by doing the first part. So I start 1 minus, the calculator has got open brackets, so I will open the brackets, plus 0.1, open brackets, 1 plus 0.1, close brackets, raised to the power -3, close brackets there. Okay, and then I say equal to, I'm obtaining 0.2486851,991. Okay, just the top part. Then I need to divide this answer divided by 0.1, and then I obtain 2.486851991. Okay, so what I have now is 2.486851991. There is an A here, I'll put it that side, and then there's 1,000 here, $1,000, $1,000. I'll put it this side. So I'm looking for the A. What I'll basically do is to divide both sides by this 2.486851991. Okay, I'll also do it this side, 2.486851991. Okay, and then I'll cancel that so that the A remains alone, and then I'll say 1,000 divided by 2.486851991. Where I'm repeating all the values, I want the accuracy here. Okay, so 1,000 divided by 2.486851991. I'm obtaining 402.11. This is my annual level payment, which is my A. Okay, because here I've cancelled, so A has remained alone there, and then this divided by that, I have the A here. All right. Okay, so this is my annual level payment. So every time a loan is repaid, this is what I'm required to pay. Okay, this is how much the bank will be deducting from my account as I am repaying that loan. So every time I'll be paying 402.11. Okay, I've solved my annual level payment. All right, now I want to discuss this figure. Remember, when you get a loan, there are two things that are in this amount. You just don't pay exact amount that you got from the bank. There is interest charged. So in this amount, there is interest charged, and there is also a what? A principal. So there is a principal element, and then there is also the interest element. Okay, so now let's see how we are going to construct the amortization schedule. Okay, now I'm on solution 2. Amortization, I'll start with year. It's for 3 years, year 1, year 2, year 3. All right, this is the year, and then each and every loan has got the opening balance. It's the opening balance. Okay, each and every loan has got the opening balance, and then we make payments. We make payments. So the payment that we are talking about is the 402, which will not be changing, and I can put it across up to year 3. 402, 402, 402. So for the next 3 years, it will be like that. The payment doesn't change. Remember what I discussed. And then in this payment, there is one thing that we know that is in this payment. There is number 1, the interest aspect, and number 2, there is the principal aspect, principal payment. And then we have the closing balance here. Okay, and then we have the closing balance here. All right, so what is the opening balance of this loan? The opening balance of this loan, of course, is 1,000, which Michael borrowed. So we have the $1,000 there. All right, just leave it like that. We know to say these are dollars, these are dollars. Okay, dollar here, dollar there, dollar there, dollar there, dollar that side. Okay, so yes, 1,000, and then the interest is pitched at 10%. The interest is pitched at 10%. So I'm basically calculating 10% of the 1,000. Okay, that's the interest that pertains to this loan. So 10% of 1,000 gives me 100. Okay, so if I want to know my principal payment in this payment, I'm paying this much, but what is my principal payment? Since we say the principal payment is made up of interest, since we say this payment, the annual payment, is made up of interest and principal, I can simply say this minus that will give me the principal payment. Okay, so 40211 minus 100, I have a principal payment of 30211. Now, what is it? There is 100, which is the interest in this amount, and there is also 30211, which is the principal, which reduces the loan amount. So for me to find my closing balance, I will simply say 1,000 minus that. So 1,000 minus 30211, I have 697.89. 697.89 is my closing balance for year 1, which becomes my opening balance for year 2, 679.89 as my opening. Again, I'll hammer 10% of this, the interest, the 10% there. So I'll hammer 10% of the balance here. So that gives me 69.79. All right, 69.79. Again, if I want to find the principal amount for year 2, remember the interest now is 69.79. So I just need to say 402 minus that, because we are claiming to say in this amount there is interest and principal. So for me to get my principal, I need to get this amount, which has got two components, principal and interest. So I'll remove the interest so that I can remain the principal part, which will reduce my loan balance here. So I'll simply say 40211 minus 69.79, and then I have 332.32 here, which will reduce my loan amount there. So 679.89 minus 332.32, I have 347.57 as my closing balance. And remember, my closing balance becomes the opening balance for year 3. So 347.57 is my opening balance. Again, we hammer the 10% interest. Okay, so 10% of that is 34.76. All right, 34.76 is the interest. As usual, I will say 40211, 402.11 minus 34.76. I have this 367.35. Okay, 367.35. Let me repeat that computation. Since there's a mistake somewhere, let me just go quickly, because I need, when I do this and that, it should give me a 0 there. Let me just verify quickly. Let me say 1,000 minus 302. I'm just verifying quickly. This gives me 697.89. All right. Okay, so I've known where the problem is, I think. the problem is here. Okay, 10% of that is actually 60. All right, so I wrote a wrong figure here. This should have been 697.89. So 10% of that is 69.79. Okay, sorry about that. I'll be quick, don't worry. So now what I'm saying is this is the interest element. So let me remove from 40211. I remove 69.79. I have 332.32 there. Okay, that will reduce the loan amount. So we'll say 697.89 minus that. I'm getting 365.57. Okay, so now here it becomes 365.57. Okay, and then 10% of that is 36.56. Yes, 36.56. So from 40211, I remove that so that I can find the principal element. 36.56. I have 365.55. Okay, so now no worries. I have 365.55, and then this is what is going to reduce my opening balance for year 3 to give me my closing balance for year 3. So I'll do 365.57 minus that. I'm getting 0.02. All right, so as you can see, this is the loan amortization schedule, and as you can see, the last balance there is a 0. If I was using Excel or computer to compute this, it was just going to literally become exactly 0. Because of the rounding off, it has given me 0.02. So if we round off this one to the nearest dollar, it's actually 0. So this is like a 2 cents. 0.02 is 2 cents. $0.02 is 2 cents, yes. Okay, so 2 cents is immaterial. It's as good as just saying this is 0. So this is how the loan actually gets to be amortized. Thank you very much for paying attention.